Okay. On that note, let's invite our market master for the morning, Mahesh Patil, Co-Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, always a pleasure to have you in our studios. Thank you so much for joining in. So, as we've been looking at the news and cues, it's been a quiet week for the market throughout, but now we have this blitzkrieg of what seems like good information, the changes to the IBC, the fact that, companies, we just had an auto ancillary company talk on our channel saying that they're interested in buying some stressed assets. And of course, that apart from oil, I don't think there's been a major global shakeout or a worry point. Is it looking as good as I just narrated it? Or would you be a little circumspect with this range-bound movement?
Yeah, I think the market, or you would look at the negative news which were there, are kind of receding, at least from a domestic perspective. I mean, we had the impact of GST, which has now gone through, and this quarterly numbers also which came in. For the first time after many quarters, we have seen that the surprises to the earnings was higher than the positive surprises were much higher. So that's the beginning of a trend change, it looks like, and getting into the next quarter where the base is favorable. I think things to be, at least on the earnings side, things are looking slightly better. Again, if you look at this time around, the breadth of the earnings improvement has been across sectors. So a lot of sectors which were kind of declining are either seeing kind of bottoming out over there. So I think as we move forward, you will see a wider participation of sectors in terms of earnings growth. Like sectors like telecom, again, you will probably see them earnings bottoming out in the next quarter. On the corporate banks, again, we've seen with resolutions coming through. And I think in the next couple of months, if we see few large ticket resolutions out of the 12 cases which have been referred to the NCLT, then that would also relieve the stress on the banking sector. You will see the provisions, which have been taken, haircuts being taken, and balance sheets getting to some extent repaired. So I would say that clearly the negative trend or the negative news which was there from the domestic side is kind of receding. On the global front, though, I think oil has been the only worry factor, I think, which one needs to take into cognizance. Again, it's not going to be a longer term. Oil will not remain at higher levels for a long term, but in the near term, because of the geopolitical risk in the Middle East, you can see a spike, and that can create some pressure because the current account deficit is slightly inching up. And if oil, say, moves up, say, around $70-75 or so, there could be slight worry on that front. But otherwise, I think things are looking better. And markets, while they are expensive, they have rallied quite a bit, need to be cautious. But I think there's no reason for anything to really worry about from the domestic side. We have elections around the corner, but I don't think the markets will really give much heed to that.
That's not a worry, you think? Because, I mean, for some, that's probably the only joker in the pack.
But we've seen that earlier, right? I mean, election results, whether it's globally, I think as long as the mood is positive, liquidity is positive, I think apart from a minor blip, market would start to look forward and probably dismiss that. So I think the whole liquidity flow is still very, very strong, and that's been the driver of the market. And with now ground, I mean, we are seeing improvement at the ground across sectors. I think that should be really supportive for the market, and one doesn't expect any large correction barring some major global risk on event.
Is the flow good in November as well?
Yeah, so the flows remain fairly strong in November also. It's slightly kind of tapering down from what we saw in the month of September, was kind of a peak month. But it still remains fairly robust. We aren't seeing any major slowdown over there. The SIP book is continuing to grow and grow at a fast pace. So I don't see any reason for the domestic flows to kind of abate. We have seen a lot of supply coming into the market in terms of new paper issuances, which has taken away a lot of that liquidity. In fact, a year till date, we have seen almost 1,20,000 crores of fresh supply into the market. In the near term, we are not seeing any large ticket IPOs of this thing. I mean, the PSU disinvestment remains the only kind of a major supply, barring some other QIPs or other things. So I think the balance will continue to remain flavor in terms of more demand for paper rather than a big supply coming in.
Okay. Well, I wanted to ask you about this IBC tweak, insolvency law tweak. Is that making you positive or negative on the corporate lending banks?
So I mean, immediately I don't think it has a material impact over there, because as long as the resolutions happen, okay, it's good for the banks, right? Whether it
Some
is
people fear larger haircuts, but not everyone agrees.
Yeah, so I think haircuts could be larger. I mean, the feeling is that in the seal sector, large accounts, the haircut to the extent of around 60% or so, which is, if that happens, then it is slightly higher than the provision which the banks have made to the extent of around 50% or so. But yeah, so one has to wait and see, because if the number of bidders for these assets is not large, then probably the banks might not get the higher realization what they are expecting. So I mean, I would say that this is good that the changes which have made, okay, in terms of preventing willful defaulters to go and bid for the assets. But purely from a banking sector perspective, I think it's probably neutral. I mean, as long as you see resolutions, you see demand for these assets coming in from other bidders, you would see the resolutions happening, haircuts being taken, and banks taking whatever knock on the balance sheet and moving forward.
So you're buying PSU banks?
So we are looking at corporate banks, yes. After some time, I think it's time to start looking at corporate banks, because it's not only the resolution of some of these NPAs, but we think that the economy also has kind of bottomed out. So it's important that the economic recovery is in sight, and with bank recapitalization, PSU banks, I think you will see overall credit availability will also improve. So that should help to relieve the stress in the sector, and you should be ready for the next cycle, right, in the economy. So corporate banks, especially the better managed ones, can be good investments over the next couple of years.
I'm going to probe you further on that then. How are you playing the recovery? Corporate banks is one way of playing it. Are you, let's say, loading up on, I'm not sure, EPC players, infrastructure, cyclicals, utilities? And if you are, then are you sort of unloading something else in the portfolio, maybe NBFCs, maybe consumer? How are you balancing this out?
So the recovery is not very strong. Okay, we are seeing a slight improvement over there. Capex and other things are still not visible. We are not seeing any meaningful pickup in the private capex, and doesn't look like it will happen over the medium term or so. There are few pockets of recovery where we are seeing growth only on the infrastructure side, railways, roads. Again, the new program which has been announced. So I think selectively, I think when we are looking to play some of these infrastructure plays, we're very, very selective. It's not
so road contractors, perhaps.
Road contractors, some of these contractors who are catering to the T&D side on the railways. I think those are companies where the order book visibility is looking good, and I think the recovery would initially start from the consumer discretionary side, and where we are seeing improvement coming through with now GST behind. A lot of these companies are seeing now spending on ad spend, so the media sector looks good. The move from unorganized to organized is also, we saw that benefit actually to some extent in this quarter. A lot of companies reported actually good margins, so that was a big surprise. So I think clearly there is some benefit, okay, which is accruing to the organized players, and that is leading to improvement in margins. So I think it's selectively across some of the infrastructure plays. Banks is one way to play that, and consumer discretionary, I think, looks good with rising income levels, rural economy starting to do better.
Okay, I just want to ask you about this big thing that all of us were expecting since morning. If the S&P were to give a positive rating but not BBB, what happens? If they give BBB from BBB minus, what happens?
So I think, again, what is happening at the ground level, what are the reforms, what we are seeing, I think it is apparent for everybody, and market is already recognizing that. So the rating agency giving a stamp on that, okay, it helps, but I don't think it makes a material difference in terms of the immediate outlook over there. It gives a larger confidence for, say, longer term money which could come into India, both on the debt and on the equity side. I think it opens up those doors over there if the rating is positive. But I don't see that really impacting the market. That event could impact the market big time either ways.
Okay, that's good to hear. Mahesh Patil, it's always a pleasure speaking with you. Thank you very much for joining us with your thoughts. So that's largely positive. Most important, of course, both the earnings and the data on the ground are indicating a turnaround. Is that the feeling that all industries are getting? We are going to ask Praj Industries.